Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at DealCatalyst. Joining me today is Matt Freund, who is president of Barings BDC. Matt, nice to see you. Nice to meet you virtually, at least. Thanks for joining me today. How you doing?
Doing well, Todd. Really appreciate you having me on the show today.
All right. Well, of course, and thank you for your time. So, I wanted to start a little bit high level. And for those who might not be familiar with BDCs, though I know, there probably are plenty in our community who are, but if you can just kind of maybe break down what are the different types of BDCs, what are some of the pros and cons for investors, how should investors think about this product when it comes to fees and alignment? If you can maybe just give us a baseline of kind of what we'll be talking about here today.
Sure. Happy to start at the beginning. And so what I would encourage the listeners to think about is that BDCs, or business development companies, are effectively portfolios of income producing assets. And so what that means is that the underlying collateral that underpins these structures is predominantly floating rate loans and in some instances bonds that are really producing current and periodic income for underlying investors. Exactly what kind of wrapper that you want from a BDC, and I say wrapper because the collateral is going to be pretty similar in terms of the underlying strategies, but the kind of wrapper that you want is going to depend a little bit on the liquidity preferences of the investor and then the fee sensitivities of the investor. As you appropriately noted in your question, the biggest differentiators across the BDC ecosystem are going to be the liquidity features of the underlying product. And so the most liquid strategies that are available are going to be publicly traded. Barings manages one, Barings BDC, traded on the NYSE. Other large asset managers will also be managing publicly listed BDCs. The benefits of public BDCs are that they typically have daily liquidity. And so if you would like to invest in the underlying portfolio, you can do that today. It trades at a stock price that may or may not equate to the value of the underlying value of the portfolio. And so the drawback, of course, to a publicly listed BDC is that the underlying value of the portfolio may dislocate from the share price. And so that's what we refer to in the industry as premium and discount. So you can either buy the publicly listed BDCs at a premium or a discount. In contrast to the publicly available BDCs, what you've seen a significant rise over the course of the past 4 years is our perpetual BDC asset class. Perpetual BDCs are typified by having a monthly subscription window, so you can buy them on a monthly basis, typically the first business day of the month, but then you can only redeem your shares on a quarterly basis. And this is a pretty consistent industry approach. As you can probably tell, having the opportunity to sell quarterly is very different than having the opportunity to sell daily, but typically they have less volatility. And so you're typically entering a perpetual BDC strategy at net asset value. And so there's very, very little premium or discount that may be experienced whenever you contrast it to a publicly traded strategy. These are the two biggest categories of BDCs today. There is a third classification of BDC, a fully private BDC. They're typically focused on institutional investors. As we think about what is available to most investors day in and day out, it's going to be the public and the perpetual strategies.
And are the investors for the public and the perpetual, do they look similar? Is it, retail investors like any day person like myself, or does it look more like, those with a decent amount of investable income that they can put towards, strategies like these?
Yeah, I would tell you that there is a pretty meaningful amount of overlap in terms of what the underlying investor is going to look like in terms of a household income or a household wealth bracket. I would tell you that people that are investing in these asset classes are pretty similar. The biggest differentiator is how long do they plan to hold them. And so if you think about someone who's say, into their retirement years, who's looking for income producing asset classes, they're more likely to hold on to the BDC for multiple years at a time. And as a result, they may be more drawn to a perpetual strategy, or candidly, someone that knows they have a long-term allocation to fixed income, even regardless of age. And so if you expect to hold the asset class for, 2, 5, 10, 15 years, a perpetual strategy is going to be something that is very appealing to you. If you're someone who might be more inclined to trade it, and so you're looking to get in and out of these liquid markets, and you're doing so based on your perceived kind of daily volatility expectations, then I would tell you that a public strategy is perhaps more likely where you're going to find value. That's not to suggest that we don't have long-term investors in our public strategy. We do. We certainly have some very long-term holders in our public BDC. But as you think about what people are really driving as they consider net new investments, their hold horizon is a pretty big and important factor as you think about what strategy you're going to be buying into. The other benefit I would tell you about the publicly listed strategies is that there's really no minimum net worth requirements. Many of the perpetual strategies do have an accredited investor, or they have a minimum buy-in.
Got it.
And so that can at times be a little bit more prohibitive. And that's something that you have to take into account based on your own individual needs and financial planning.
So the term private credit has obviously been a pretty popular one the last few years, and while it started off kind of fairly focused on direct lending, that the terminology has kind of since expanded to include pretty much anything these days. It feels like
Yeah.
ABF as one strategy. How would you say the attractiveness of these vehicles, whether it be public, perpetual, or even the third one you mentioned, as a investment opportunity when you start comparing it to kind of where private credit has kind of expanded and gone into, whether it be ABF or some of the other asset classes out there?
Yeah, Todd, that's a great question. And as you think about the nomenclature that you just walked us through, this whole term private credit has really taken on a mindset of its own. And so whenever we launched our BDC strategies, and frankly, whenever we launched our commingled fund strategies years and years ago, we actually referred to the product initially as bank loans, because we thought that it really told people what we were investing in. We're investing in securities that look very much like bank loans, but we're doing it in kind of an investment style wrapper rather than through a bank, obviously, which Barings is not. And so as you kind of see the evolution of the terminology over the course of the past 10-ish years, a couple of things have happened. I think that importantly, private credit should always be considered to be exactly what the name is. It's private, it's illiquid, and it's non-traded securities. And that's really all you can learn from the terminology around private credit today. Exactly what the underlying type of loan structure looks like is going to vary from asset class to asset class to asset class. As you said, private credit used to mean direct lending. Our strategies at Barings in our private credit ecosystem are predominantly sponsor-backed first lien strategies, but that is not to suggest that that's the only kind of collateral out in the ecosystem. You do have private credit in an ABS wrapper. You have private credit in an asset-backed wrapper. You've got private credit even on the investment grade front these days. And so as you think about what does it mean to be invested in private credit, I would encourage everyone to think about private credit as demanding an illiquidity premium over their liquid market counterpart. And so you need to understand, what asset class do you want to invest in? Is it going to be loans? Is it going to be bonds? Is it going to be ABS? You need to first figure out the sectors that you want to invest in and the asset classes you want to invest in, and then figure out if you can get a premium in a private illiquid wrapper relative to the public market counterpart. As we think about the products and strategies that we are providing at Barings in our direct lending business and our global private finance business, it is a sponsor-led private equity-backed strategy. What does that mean? It means that when we think about providing an illiquidity premium, it should be relative to a broadly syndicated leverage loan index. And the way we think about illiquidity premium in our specific asset class is call it 150 to 200-ish basis points over the long term. As long as investors are getting an illiquidity premium, you can invest in a wide range of private credit strategies that just need to be appropriately matched from a duration perspective with the underlying investor's needs.
So with the new administration, there's certainly been a lot of talk around, I guess a more pro-growth regulatory environment. In the BDC space specifically, do you see any potential structure changes coming, whether it be, public and private beginning to kind of overlap and mix a bit more. Maybe there's 3 options now. Is there 4 or 5 options in the future? Like, do you see any real changes coming to the BDC space given the current environment that we're in and kind of this new look at, all right, we want pro growth, we want more activity going on? Do you see anything materially changing, or is this a product that's kind of, come together? It's pretty structured. You have your options, and that's kind of where we're going to land.
Yeah, I would point to the fact first that the perpetual BDCs as an asset class have grown tremendously over the course of the past 5 years. If you look at the capital formation in the space, I was looking at a report just earlier today that suggested that capital within BDCs has eclipsed more than 400 billion. That's up from 200 billion only 3 years ago. And so as we think about the catalysts for capital formation, they've been alive and well for the past several years. As we think about what could change that on a go-forward basis, I do believe that the new administration seems more inclined to relax regulatory frameworks that have previously existed. And so does that incentivize the further creation of more BDC investment capacity? Perhaps it certainly may, but I do think that it's going to be really hard to separate the actions from the actions of the administration from just the sheer growth and acceptance of the broader asset category. It's been really important that I think that the retailization of private credit through the BDC access point has been a point of no return. There's a tremendous amount of uptake in the retail wealth channel that wasn't there 5 years ago. And if anything, perhaps the growth will accelerate, but it's grown quite a bit over the past few years.
What is the interest rate environment, which, let's say that if we had this conversation a year ago, it'd probably have a different feel to it than it does today. What does that mean, and a potential shift in policy mean for BDCs?
Yeah. And so I stressed kind of the importance of relative value in the context of private credit and liquid asset classes. I'm going to stress that again now. So as you think about where are interest rates headed, I would encourage all investors to think about it on a relative value basis. This is a floating rate asset class, at least the way that we manage it. And so as you think about where is good value, where is good yield, where is good return in the context of a floating rate fixed income asset class, we believe that the asset class provides very compelling returns when interest rates are 4%, and we feel like it provides very compelling returns when interest rates are 2%. In absolute terms, of course, the investor is getting more dollars of return as yields rise. But as yields fall, keep in mind that other income-producing asset classes are also likely to fall. And so as we think about the relative performance of BDCs, we feel like they're very, very well positioned. As we were chatting kind of before this conversation, the quid pro quo is just the health of the underlying borrower. And so as interest rates get higher and higher, the underlying borrowers, of course, experience more and more stress. And so one thing to keep in mind is that, at some point, the interest rate cycle is just too punitive on the underlying issuer. And you've got to be really careful in terms of underwriting your portfolio as a through the cycle portfolio, such that whether rates are high or low, you don't have an uptick in defaults.
Leading into my next question perfectly. Thanks for teeing it up, which is, how are, borrower companies continuing to weather what seemingly, like I said, last year, we would have had this conversation. They thought maybe relief was on the way. But now it seems we're in a higher for longer rate cycle. It doesn't seem like the Fed is itching to drop rates, maybe, once more this year, or depending on who you read, could be once or twice more. But how does that impact the borrowers, and then ultimately does it change your strategy on kind of where to go next in the market?
Yeah, it's a great question. And so we underwrite every issuer with an expectation that during our hold horizon, the issuer is going to experience a recession. And we don't know if that recession is going to be brought on by consumer confidence or credit crunch or liquidity concerns from a macro perspective. But we believe that in disciplined underwriting, over the course of every investment that we hold within our investor portfolios, there's going to be weakness. And so as we think about that, we think that we have really institutionalized the approach within the Barings portfolios that a lot of our issuers are pretty well battle tested. And I think that we would point to the fact that as interest rates started to rise only a couple of years ago, we were doing a lot of ad hoc work on the portfolio, trying to understand possible implications of defaults, possible implications of recoveries. And a lot of the data that we have now in the rearview mirror showed that the portfolio was designed incredibly well. Our default rates did not spike. Our default rates, again, continued in line with historical norms due to a lot of idiosyncratic reasons. Think about failed acquisitions, weak management teams. We actually had a facility that burned down within one of the portfolio issuers, and of course they experienced stress. But we did not see a wave of downgrades in our portfolio simply because interest rates were higher. And as we think about where we are today, I think that a lot of the management teams of the underlying issuers are now aware that interest rates can be higher. You know, if you talked to a borrower 5 years ago, 10 years ago, in a zero base rate environment forever, they of course felt like the money was free. I think that the management teams over the course of the past 2 years have realized that money has a real cost to it. They're being a lot more thoughtful in terms of how they're budgeting. And as a result of that, I feel like we're actually in a better place today than we were even 3 years ago with the underlying health of the portfolio.
I mean, isn't there it's kind of a bit of a natural cycle. I mean, it's not like we were going to be stuck in zero rate forever. I mean,
That's right.
it had to kind of reset a little bit. And so you would think companies would adjust to that. But I mean, going back a little bit, obviously we went through the COVID period. Does a shock like that teach you more about the portfolio than say maybe your typical recession? Because that was a pretty volatile, like, all right, no business, and then stuff started to open, or depending where you were. I mean, does something like that give you different lessons than say your typical recession over a period of say a months or years?
Yeah. We definitely learned different things in COVID than we would in a conventional recession. The things that we learned in COVID were really how much confidence some of the underlying management teams and private equity owners had in their underlying business models. Of course, some businesses were dramatically impacted. Think about leisure, hospitality. We don't invest in restaurants and retail, but of course, those sectors were impacted pretty dramatically. And then you can think about healthcare and the overall impacts to the portfolios that have either direct or tangential exposure to healthcare. And we learned a lot about behavior of the underlying management teams and of the underlying private equity firms. Of course, COVID was a transitory experience. It was very difficult for, call it 6 to 9 months on the issuer level. After that, a lot of businesses were able to kind of right-size their cost structures and or adjust to what was the new normal. And if you look at COVID now with the rearview mirror, you can really assess the fact that the borrower and issuer performance is really transitory from 2020 to 2021, but kind of post 2021, it was more to a business as usual dynamic. I think in a more conventional recession, you're going to be matched with a slightly different set of expectations. You'll have to figure out how quickly management teams can adapt, how quickly can they really scale their infrastructures to adjust to permanent and structural shifts in demand. You're seeing that now with some of the industrial and automotive manufacturing components. I think that there's a broad sense of uncertainty in the ecosystem, and it's really testing the flexibility of some of these supply chains to a manner that we haven't seen up to this point.
So it seems PIC has been in the news more the last, say, 6 months, maybe even a little bit longer than previously. I mean, how should PIC be used and evaluated?
Yeah, there's a lot of there's a lot of work that's been done across our ecosystem with respect to PIC. Some of the rating agencies have tried to unpack it a little bit. I can tell you that on the liability side of our balance sheets, a lot of our banks spend a lot of time talking about PIC and how it's impacting the portfolios. I would tell you that it's really important to understand a lender's strategy as they approach PIC. As a broad theme, we do not expect for PIC to be a meaningful portion of the returns within our income producing portfolios. If you look at our publicly listed all of our BDCs, in fact, you're going to see that it ranges between 4 and 6% on a trailing kind of 4-quarter basis. And that's the range in which we think is pretty reasonable. It reflects very modest degrees of change quarter on quarter. That is consistent with our originally stated strategy. We don't have a lot of ARR loans, and we generally believe that first lien issuers and first lien companies need to be able to service their interest in cash when it comes due. That's our strategy. That's how Barings approaches it. Not every manager is going to approach it the same way. There are managers that will tell you that a higher percentage of PIK allows them to drive better returns. That may be true. We've also seen some evidence that higher percentages of PIK actually have a higher correlation to underperformance and default rates. And so I do think that it's something that in the here and now is very difficult to dissect and assess. But in a few years' time, with the benefit of hindsight, with the benefit of workouts and recoveries, I think we'll start to see exactly which narrative prove to be a little bit more accurate. Whether or not PIK is yield enhancing or perhaps a harbinger of credit stress to come, I think the jury's still out.
So there's been, given the terminology we talked about before in private credit, a lot of new entrants are clearly coming into various markets under the private credit umbrella, direct lending included. And that line between public and private is starting to blur a bit more, probably now than we've seen in a long time. And so, how do you think about new entrants into the market and that blurring of the public and private lines?
Yeah, I do think that the market has grown and matured. And so as we think about where the broader markets were in private credit and direct lending specifically 10 years ago, I think that there was a lot of opportunity. Barings enjoyed a lot of that opportunity, of course. Our platform has grown tremendously over the course of the past 10 years. And at the stage that we are now, we believe organizationally that you've got to have scale within a credit ecosystem in order to maintain relevance in your markets. And there are a number of very large direct lending franchises out there. Some of them that are run very, very well, apart from our own. We've also heard that there are approximately 1,500 direct lenders globally. And it's hard for me personally not to imagine that in the next credit event that half of them aren't just going to get washed out. And so as you think about kind of what is happening with the growth in the ecosystem, what are the new entrants and new competitors doing? We haven't seen so much on the new entrants perspective, but what we have seen is an expansion of product capabilities within large integrated asset managers already. You alluded to kind of the disintermediation between broadly syndicated loans and private credit. Kind of what's that liquid high yield space and how does that play into private credit? There are a number of managers out there that are very actively looking to disintermediate the liquid loan space. They will do so with varying degrees of success. The challenge is just going to be that the issuers, whenever it's really a win for the issuer, insofar as the issuers used to need to turn to the liquid loan markets to finance their businesses. Now they can turn to the liquid loan markets or the direct lending ecosystem to finance their businesses. And with more opportunity and choice comes a better deal for the underlying issuer. And so as we think about kind of what happens, there will continue to be a blurring of lines. There will continue to be a reason for both banks and direct lenders to exist. But it's really going to benefit the broader capital markets functions more so than anybody as we think about the reasons for that to evolve.
There's been a pretty big shift in the BSL market this year with the rise of ETFs. Obviously, ETFs have come along, but it seems like 2024 at least had a pretty banner year for ETFs. And then on the flip side, there's private credit ETFs where it seems like there's, I think, 2 or 3 that are in the market. Some are pretty more specialized. There's one that had just launched. Do you view the ETF product as competitive in any way? And kind of where do you think of BDCs versus ETFs versus maybe some other innovations that are beginning to kind of take root in the markets?
Yeah, I would share that the underlying collateral needs to largely match the wrapper that it's in order for a successful investment strategy to take hold. And what I mean when I say that is that the semi-liquid product, the perpetual BDCs that we spoke about a moment earlier, they're really well designed for illiquid private credit because you're honoring redemptions on a quarterly basis, which generally matches whenever you have kind of principal and interest payments and repayments on the underlying loans. And so there's more or less a matching of liquidity on a funds in and funds out basis with respect to the vehicle itself. With private credit ETFs in particular, I think that there's more work to be done. The private credit ETFs that I've seen have kind of a slice or an allocation of them that's somewhere between 20 and 35% of the underlying portfolio is actually true private credit, and then the balance is going to be all BSLs. That makes sense because on an ETF, it's impossible to ramp ETFs or to ramp private credit loans in the same capacity as you're having inflows into your ETF. There's just a mismatch. And so whether or not there will be kind of some really successful quote private credit ETFs that launch, I think remains to be seen. But I do have a little bit of skepticism in terms of where that market's ultimately going to be able to go. That said, I do think that a mix of private credit and BSL probably solves an investor demand. The publicly listed BDCs, as we talked about earlier, they're available daily and they contain all private credit. If someone is looking for something a little bit more passive, perhaps a hybrid of BSL and private credit strategies is what they're looking for. I would just encourage investors to understand the risks, particularly with respect to liquidity and NAV, whenever you're investing in a hybrid product such as that.
Speaking of risks, I wanted to actually go back one question and ask you a follow-up to the new entrants, and you had referenced scale. And we obviously had an issue with scale coming out of the GFC with too big to fail. I mean, are we heading in a direction of there's just 10, 15, 20, 25 dominant players in direct lending, and some of the smaller players get gobbled up and we end up having a, for lack of a better term, kind of a group of dominant players, and they are, have more pricing power, and risk is, kind of offset where it might be? Or do you still think there's room for smaller players and maybe more niche players in the markets?
Yeah, look, I think that's a good question. I would point to kind of there are a couple of examples that I think lead the way in terms of where private credit and kind of asset management may be headed. One, of course, is the regulated banking ecosystem. Banks are subject to regulations that asset managers are not. And so in some ways, they're forced to consolidate in ways that asset managers will not. But if you think about kind of how you're serving that ecosystem, the bank market, in the US, we have 4 very large banks, but then there's a very long tail of banks as well. And it's not to suggest that smaller banks are bad or inferior in either way. They just have a niche that's carved out that is really unique to how they approach the market. And I think that's a fairly reasonable sort of outcome to anticipate. I think the other example will be private equity firms themselves. And so if you look at private equity firms, there have been some that have grown through tremendous scale, and many that have had very, very successful careers with very, very successful investment teams, and as a result have raised a tremendous amount of capital. And they do kind of command the lion's share of the headlines. I think if you look over the course of the year, you can call the top 6 or 8 private equity firms, and they're the ones that are featured in, frankly, stories like yours, as well as kind of the Wall Street Journal and Bloomberg. And you see that they're more active. That said, we know that there's a long tail of mid-market and small private equity firms that are continuing to produce value for their underlying investors. And so I think that as those two examples have kind of walked the path before us, I would expect private credit and the asset management ecosystem to be the same. There is going to be large dominant players in the ecosystem that will naturally command a larger percentage of the market share. But I also think that there's going to be a pretty meaningful number of mid-size shops that are able to kind of carve out a niche for themselves. It'll be tough to be a relatively, a first lien focused sponsor backed strategy on a platform that's, call it, sub $5 billion of scale. That's just a tough business to be in, as kind of a single strategy. But there will be specialist credit managers that continue to thrive in the ecosystem, even without scale.
Before we get to our fun questions, and then out the door, I did want to ask, kind of what does the next 12, 24 months look like, in terms of what investors should be keeping an eye on and kind of looking out for, from your perspective?
Yeah, I mean, it's an interesting time to be having this interview. On the drive in this morning, the snippet that I heard was that we're not even 100 days in to the current administration. I thought that was a staggering realization. And so as I think about how to anticipate the next 12 or 24 months, I would just tell you to brace yourself for anything. That's exactly how we're approaching our portfolios. From a regulatory perspective, of course, everything and anything is on the table, whether it be on the fund complex or whether it be on the portfolio assets themselves. And then as we think about kind of the global trade is clearly top of mind for everyone. I think that we are mindful of unintended consequences we get asked pretty regularly, like, what do we think the impacts of Doge and tariffs are on the portfolio? And the stock response that I have for people is, we know where the highest risks in the portfolio are, but what we don't know is the secondary and tertiary impacts and kind of what that ultimately means for the broader economy. I do think that we're more likely than not to be surprised. And so I would just encourage folks to be mindful, cautious, operate with maybe a slightly more defensive balance sheet as they think about 2025 and into 2026, and prepare for the unpredictable, because I do think that if anything that we've learned in 2025 so far, it's been that you should anticipate the unexpected.
Yeah, that's a good way to put it. So we have a few fun or lighter questions as we wrap up here, and thank you again for your time.
Oh, of course.
Favorite sports team or hobby?
Yeah. So favorite sports team. I'm originally from the Midwest. And so I am actually, whenever I moved to Charlotte, Charlotte, North Carolina is the headquarters of our Barings global franchise. I got to keep one of my sports franchises with me. And that was the St. Louis Cardinals. I'm a big Cardinals fan. They've had a pretty rough string over the course of the past couple of years. But as someone who grew up with the Birds in St. Louis, I have a lot of confidence that we'll find our footing again, even if it takes us another season or two.
As a Mets fan, 2006 still sticks with me.
Yeah, there you go. There you go. And we were on the right side of that trade.
Yes, indeed. So, one surprising thing about yourself.
Yeah, so I feel like I'm a reasonably predictable person in my line of work. I feel like that probably proves pretty prudent. But one thing that people do often remark about, I try to very militantly be in bed every night by 9:30. I feel like if I can get a great night of sleep, then I can start my day on the right foot. And so people are usually shocked that is something I aspire to. I wouldn't tell you I hit it 100%, but I certainly try.
Wow, yeah. That's pretty early for me.
Exactly.
I don't
A
know
lot
if
of
that's a
people
good.
have that
I don't know if
reaction.
that's a good thing or bad thing. To be honest
I
with
start
you.
my days more often than not with a four handle on them, and so you just have to be in early to bed, early to rise.
If you could recommend one book, what would that book be?
Yeah, so some friends of mine and I were talking about The Psychology of Money, is what it is called. It's a series of short stories by a Wall Street Journal columnist. It's not a very thick read by any means, but it talks about just a handful of anecdotes in terms of like personal finance theory, and some of the takeaways that some of these anecdotes have kind of taught people over the course of their lives. And some of the things that really stick out with me, there's a quote in there that says, don't compare yourself to people playing a different game than you're playing with when it comes to your money. If someone is trying to achieve a financial outcome for themselves, that you really shouldn't compare your financial outcome to what they're trying to do, because they just don't have the same needs, wants, and desires that you have. And I think that it really drives home a lot of personal finance theory, and helped me personally think about kind of what I'm trying to accomplish with my own financial expectations, and really found it fascinating in the context of some of the short stories that it told. So the Psychology of Money is what I would recommend.
All right. Well, I'll have to check that out. And then the final question is, what's the most exciting part of your job?
Watching the growth, watching things and people and businesses grow. And I'd say that in the context of I've been very fortunate in the time that I've been with Barings. It's been 10 years since I joined this franchise. And in that period of time, I've seen relatively small funds grow into being very large funds on our client side. I've seen some small investors become very big investors and anchors in some of our strategies. I've seen some of the analysts on our business grow and develop into directors and managing directors on the franchise. And all the way around, it's really just seeing the opportunity set that continues to expand. And so as I think about the best part of my job is watching us do things better than we did yesterday with a team that has helped fuel that franchise growth. And so as I just kind of sit back and think about why do I enjoy being here and what really drives it all home, it's watching us build something better than we had. And the growth of all aspects of our business is certainly what I prize the most.
Well, Matt, I think that's a good place to end it. Thank you very much for your time. It was great to at least chat with you for a little bit and get to know you. Thank you for coming on the show.
Likewise, Todd, I really appreciate you taking the time and look forward to continuing the conversation.
Thanks so much.
Be well.
You too. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.